Okay, let's have a look at the market that was for the last week and the market that will be, or at least our best guess as to what will be. The yield curve continues to reflect higher for longer. So we have a bear steepener going on. Bear steepener means the long end of the curve is increasing, which we have. We can see from the 2-year all the way out to the 30-year, all rates have increased. This is reflecting the path of the short rate going higher than what was initially priced into the long end of the curve and staying there for longer. Also, last week we hit all the way through to the 3-year. All of those hit their highest for the year. Some of them ended at the high for the year, but they all hit their highest for the year. I think actually they all pulled back on Friday, but hit their highest for the year. Yield curve is still inverted, 59 days now, but it's only 20 basis points inverted. Inverted not by the 2-year dropping. The 2-year has increased over that period of time. Since Jackson Hole, the 2-year has increased, but is increasing. Sorry, the slope is, the inversion is decreasing because the 10-year is increasing. In fact, you have increases all across the 210, 510, the 220. The 1030 basically unchanged. Even the 3-month to 5-year and the 3-month to 10-year are increasing as well. We got 17 days left until the next meeting. Not much going on next week. The next big thing is CPI. So we'll have a look at some of the components and see if we can't sort of guesstimate where we think it may come in. Fed's balance sheet for the week ending August 31st for that week was down 23.8 billion. So for the month of August, a little over 54 billion rolled off. All of the caps increased for September. You're going to have 60 billion in treasuries, which they say they can get to with coupon bonds, and they're going to let some money market securities run off, some of the T-bills run off. For mortgage-backed securities, it's 35 billion, but they said they will not get to 35 billion. So the combination of the two is 95. I'm pretty sure they'll hit the 60, but they won't hit the 35. So we'll have somewhere higher than 55 billion, but something lower than 95 billion that will roll off in September. But if you check back here every week, we will have a tracker. We'll keep an eye on it. Credit spreads increased all across all the credit qualities as well. The probability of the hike in September last week was 61% probability of 75 basis points. That's now moderated to 57%, and the 50's gone from 39 to 43. Our year end ending at 3.5 only has a 9.2% probability, and it's evenly split between ending the year at 3.75 and ending the year at 4%. There were 2 Fed speakers. Of all the Fed speakers last week, 2 were saying 4% or higher by year end. Some were 3.5, 3.6, but 2 were at 4% or higher by year end. And I think that really depends on what the market does. What the market is doing here with credit spreads, what the market is doing here with yields. This is helpful for the Fed. That implies that they don't have to go as high as what they need to do or what they otherwise would have had to do to restrict financial conditions. And we're going to look at a financial conditions index and see why that is the case. But as long as the market continues to cooperate with the Fed this way, you actually have a higher probability of having a lower terminal rate than a higher terminal rate. I think the big story from last week in rates is in this top chart right here, the real rates. The 5-year at 0.75, 28 basis point increase. That's a 50. It was at 47. That's basically a 50% increase in the real rate to 0.75, putting in the high of the year on September 1st, finishing September 2nd unchanged from the day before, 75 basis points. We look at the 10-year. June 14th, the highest real yield was 0.89, sitting at 0.73 right now. So we're only 16 basis points under where the 10-year hit its high of the year. The 20-year is only 8 basis points below, and the 30-year is 1 basis point below the year-to-date high. And consistent with a bear steepener and real rates increasing, we have the break-even rates decreasing. Let's look at our housing market. Nothing good to report here. Nothing good except one little bright spot. And I just haven't figured out what it means yet, but I'll show you that bright spot when we get to it. 30-year fixed 6.02. We're back over 6%. It hit 6.23 on September 1st. You can see that it for Friday's close, it fought back 21 basis points then at 6.02. Last week was 5.73, so 29 basis points higher. FHA 5.32 was 5.12 last week, 20 basis points higher. We can see that on September 1st, 5.55. You can see it gave back 23 of that just on Friday alone. So Thursday, mortgage rates hit the highest of the year and gave back on Friday, or at least clawed back some of that height that they had. But these are still pretty high mortgage rates. Mortgage applications down 3.7%. This is for the week ending August 26th. No surprise here. Refis down 7.76, and the purchase index down 1.82. Last week we had some announcements from some banks that some layoffs occurred in their mortgage departments, which refis make up a large portion of mortgage applications. If refis they're at I think 2-decade or 3-decade lows on the refinance index. Well, you don't need those people, right? Housing price index for June up 0.1% month over month. Year over year was 16.2%. This is this housing price index. This is for houses with guaranteed mortgages. To look more broadly, we can look at Case-Shiller. It was up 0.4% month over month, or 18.6% year over year. And this measures the housing prices in 20 metro regions across the U.S. Housing prices, still up there, but housing prices they're like wages. They're sticky on the way down. They don't drop as much as activity does. So if you look at they drop in existing home sales, or the drop in new home sales, or in mortgage applications. They're significant drops. But prices tend to hold up fairly well. Getting something like a 10% price drop, or even thinking about 20% price drop, that's hard to do. Usually doesn't do that. Buyers usually just keep their house. Rather than putting it on the market, they just keep it. So you get individuals who pretty much are in the position where, well, I gotta sell. I don't want to, but I gotta sell. But if you have a choice, you sort of keep it off the market. We can see with new listings year over year, we had negative 15% August 13th, dropped to negative 12, holding at negative 12% below last year. Median listing prices. This is just the listing price. Not the transaction price, but the listing price, up 13.2% year over year. That's coming down. From 13.3, you got a 14.4 here, dropping to 13.2. Year to date, though, still up 14.6. What else do we have here? Active listings are up 26% over last year, so more inventory. They're selling at a slower pace. We have 5 days slower. We did have 5, then it dropped to 4. We're back to 5. So it's, you can call that unchanged over the last 3 weeks. But year to date, still faster. Even though the momentum is slowing down, year to date is still faster. So this is listing, right? And this is tracking actual transaction prices. So year over year, 16.2 here, 18.6. But to get a better measure, you'd look at the month over month and you'd say, well, if we annualize that, what do we get? The best way to do this is to look at the last 3 months, the month over month, take the average of that, and then annualize those. If you do, you'll find that they're coming in lower than both of these numbers imply. So this is backwards looking. This is for the month of June over last year's month of June. If you want to look at it going forward, you can take a 1 month and annualize it, but that can be noisy. So if you take the average of 3 month over months and annualize that, you get a better idea going forward of what we can expect to see. Let's jump to the jobs report, and then from here I'm going to combine a data point out of the jobs report and tie it back to housing, and there's a question mark, and you'll see what I mean when we get to it. This was interesting. We had an increase in the unemployment rate from 3.5 to 3.7%, but the participation rate went from 62.1 to 62.4. So whenever we have two things moving like this, you kind of want to disaggregate it and break it down and say, well, how much did the unemployment rate change because of jobs added, and how much did the unemployment rate change purely because of the participation rate? So we're going to decompose it into its two effects. So the way we would do that is, first we hold the participation rate equal at 62.1. We say, okay, well, let's make that 62.1. This 172,000, this is the civilian non-institutional population, and that can increase because of individuals leaving the military, joining the labor force, of people turning 16, things like that. So that would have happened no matter what. That 172 would have happened. If we multiply it by the 62.1, we would have a labor force of 164,066,000 instead of 164,746. Let's assume the same amount of jobs were created. This is how many people would still be employed. This would be the number of people unemployed. That would result in a 3.25% unemployment rate. Last month, you know my feeling about the second decimal here. I'm not going to bring it up again, but there's information there, right? 3.45 was the unemployment rate last month. So holding the participation rate constant, we would have gotten to 3.25%. However, because a lot of people joined the labor force, we ended up at 3.65. So the job market lowered the unemployment rate by 0.2%, and the people coming into the labor force, increasing the participation rate, increased the unemployment rate by 0.4. So when you decompose it that way, we see that, if we're looking at 3.5 to 3.7, people are losing their jobs. No, they're not. People got jobs. We went from 3.45 down to 3.25, and a bunch of people saying, the job market is hot, we should get in on that. And they joined the labor force, increased it from 3.25 to 3.65. That still represents a very tight labor market. This is the household survey. This is the establishment data. Here are the jobs created based on the household survey. Here are the jobs created based on the establishment data. And there was discussion over the last several months that, the household survey and the establishment survey are saying two different things. The establishment survey is saying more jobs are being added than what the household survey is saying. Well, now it's reversed, and I don't hear anybody talking about that. Interesting. We've already mentioned the big difference between the two. The establishment data looks at jobs. Is there a job? Yes. Is there a job? Yes. Is there a job? Yes. Well, these three jobs may be held by one person. Well, the household data says you are a person in a household. Are you employed? Yes. It doesn't say how many jobs you have. It also has an age bracket that says if you're below or above these ages, don't bother answering these questions, whereas the establishment data can hire somebody below or above the age and there's a job. So because you have the different ways of counting, you have that possibility going on. But it is important to keep in mind that holding the participation rate constant, you did get lower unemployment, went from 3.45 to 3.25, that the increase that we saw was purely a result of the increase in the the increase in the participation rate. That added 40 basis points on, resulting in an unemployment rate that only went up 20 basis points. So that's telling you that even with all those people coming in, the economy was still strong enough to offset what the unemployment rate would have been. Because just the increase in the participation rate would have brought this from 3.5 to 3.9. So hard to say you're in a recession when the economy is still creating jobs, right? Let's look at the cost component. Aggregate payrolls, not average here. We're looking at aggregate. That means everybody who's working. That means we take all of the hours multiplied by all of the pay. You get the aggregate payroll, aggregate income, well, measured as best you can by the payrolls. Non-supervisory, month over month annualized, 3.86. If you take the month over month and annualize it. Year over year, 9.94, but again, that's backwards looking, right? So if we take a timeline and we say we're here, and this is where they were last year, you're saying, okay, well, it's up 9.94. But if you just look at the last month and you see the increase here and you say, well, let's annualize that going forward, 3.86. And you've got to get somewhere between 2 to 4% to bring that inflation component down under 2%. 3.86 month over month annualized. That's not looking too bad. If we look at July over June annualized, this is August over July. July over June annualized was 10.9. So there was a big drop in the month over month for the aggregate payrolls in August. If we're looking at aggregate demand, we want to look at aggregate payrolls. Because that is the amount of money available in the economy to be spent. If we look at all employees, this is non-supervisory now. If you look at all employees, month over month annualized is 3.5. That means taking out the supervisory component to get to the non-supervisory, it's 3.86, implying that non-supervisory is still seeing higher wage gains than supervisory employees. 3.86% annualized on aggregate incomes means that you can expect, if marginal propensity to consume stays constant, you can expect to see a 3.8% aggregate increase in personal consumption expenditures. That again does not sound like we're in a recession. Okay, let's look at two indicators here. This is all employees construction. Since we had the jobs report, it does break it down by industry, and we do have a construction industry. So let's look at the construction industry. And this is percent change from a year ago, seasonally adjusted. Look at the trend at the very end of the chart over here. These are recessions over here. Look what happens to construction jobs going into recession. It turns down well before the recession here. Starts turning down well before the recession. Same here. It started turning down here. If you think back to the last 2 quarters of 2019, there were calls for a recession in 2020 because most of the data was turning down. It just so happened that you got a pandemic right at the same time that probably cleared out a lot of recessionary pressure that already existed. So that's why either it delayed the recession or it cured the recession by causing one at the same time, right? But in the absence of the pandemic, I think we probably would have had a recession at that period of time, but we don't. But look what's going on here. It's going up. Well, the housing data we're seeing is all turning down. This is not. You would expect that, well, if you're building fewer units, wouldn't you have fewer construction workers? And we're not seeing that. So that's kind of a question mark right there as to what's going on there. Now, this construction could be, this is residential and non-residential. And, GM's building that big battery plant in Ohio, $2 billion. So, okay, well, $2 billion, you'd need probably about 2,500 homes being built to equal $2 billion. So when you see new home construction, you can say, well, if we didn't build that, that's equivalent to 2,500 homes. Does that move the dial? Not really. Doesn't really change very much. Because that's such a small number. Even though you got quite a bit of this going on, you still have this. Again, look what's going on before a recession. This is construction. This could be non-residential and residential, but look at the downtrend before each one, 4 times basically, and here is going the other way. Another good indicator is durable goods, and here we're going to look at new orders, durable goods. And again, we see the sort of same trend in front of every recession. You see sort of a downward trend. Here we had a downward trend, but no recession. And here we had a downward trend, which is consistent with this downward trend over here. It's consistent with construction employment, but no endogenous recession. By endogenous, I mean a recession caused by actions within the economy itself as opposed to some exogenous event. This pandemic here is an exogenous event, and that's why you get a recession from that. Not as clear an indicator as construction spending, but look at what we're doing here. We're going sideways. Before this recession, there was a downturn. Before this recession, there was a downturn. Not every downturn leads to a recession, but every recession is preceded by a downturn. We're going sideways. Now, this is real data because you're counting people. Well, you don't adjust people for inflation. You count people. Whereas this is new orders in billions of dollars, but I changed it to percentage change from a year ago. So this is a nominal number here. But again, it doesn't really matter because all of this is nominal. This nominal series turned down before a recession. This nominal series turned down before a recession. And we're going sideways. Neither one of these two indicators is suggesting that we have a recession. Or that one seems to be looming because it turns down before one. This is turning up, and this is going sideways. Sort of not agreeing with all the people out there who think that we are already in the middle of a recession. And last week we adjusted the first quarter and second quarter GDP by weighting GDP with GNI, gross national income. And we saw that in the first quarter, doing that gave us real GDP of 0.1. The second quarter gave us real GDP of 0.4, which is growth, growing quarter over quarter. All right, we are getting to the heart of what this week's video is going to focus on, which is financial conditions. We're going to look at the Adjusted National Financial Conditions Index put out by one of the regional Federal Reserves. We'll go to the website shortly and have a look at what indicators are involved in this. And the case that I want to make here is that the market pretty much controls one of these components. There are three components. One is risk, one is credit, one is leverage. And the market's actions work on the leverage component. And the more the market eases financial conditions, the more that the risk component and the credit component have to contract to tighten financial conditions, which means higher rates. So the more the market works against the Fed, the more they guarantee that rates are actually going to go even higher. That the best place for the market right now is to go sideways. We're at 3,900, go sideways. And if you go sideways, then you won't have higher for longer. You'll have somewhat higher, but not higher, and somewhat longer, but not longer. You can actually lower the terminal rate and shorten the amount of time if they just go sideways. Now, the Fed is well aware that the market is more in control of the leverage component than they are. Hence the Jackson Hole speech. You have to make it very clear to the market that there is no point anticipating anything. Do not price anything into this market, because if you do, we will beat it out of you. So let's have a look at what we're doing on this. There are two versions of this index. There's the adjusted NFCI and just the NFCI. For the National Financial Conditions Index, the zero line is a long-term average. Anything above the zero line would imply tighter financial conditions than the long-run average, and anything below would imply looser financial conditions than the long-run average. The adjusted index is a conditional average. It is saying that the conditions are tighter or looser, conditioned on the state of the economy. So whatever state of the economy we're in, you look at financial conditions and you say, given these economic conditions, the financial conditions are looser than would be expected given this. So it's a conditional average. So anything above the line, we would say we are tighter than what would be suggested by economic activity and inflation. And there are three components. Risk, this is measuring volatility and funding risk in the financial sector. We'll look at all the components that make this up shortly. There is credit, which measures household and non-financial business credit conditions. Non-financial meaning any company that's not a bank. non-financial. So household and non-financial business credit conditions. The interest rate, the Fed adjusting the short-term interest rate, can affect this and affect this by making credit less available or introducing some level of risk in the financial sector. This one is controlled primarily by market expectations, debt relative to equity. And then you have your adjustments, which are this part up here. Only for the adjusted index do you have your adjustments. This is components of financial conditions uncorrelated with economic conditions. Therefore, the black line that you see here is the financial conditions relative to the current economic conditions, which we've already described. So the bigger the adjustments, you notice that it moves the black line up. So this is saying that given in months where you have this kind of thing going on, it's saying given what the economy is telling us, monetary policy is not really this loose, it's actually up here given what we have in the economy. So the economy looks like it's a little bit weaker than it should be, it pulls this up. So that's why you have this going on. January, once you get into February, March, April, some of the economic indicators started turning down. And then, it looked like it was going all in the right direction, and then it sort of went the other way because you had the market bottom happen over here. And once you had the market bottom, look what happens. Right? There you go. These went from being pulling our index up to dragging our index down, showing looser financial conditions. But there's Jackson Hole. There's the week after. Look at how much tighter it has gotten. So let's read what we have down here so that we understand what we're looking at. The three sub-indexes of the National Financial Conditions Index, that is risk, credit, and leverage, allow for a more detailed examination of the movements in the index. Like the index, each is constructed to have an average value of 0 and a standard deviation of 1 over a sample period extending back to 1973. The risk subindex captures volatility and funding risk in the financial sector. The credit subindex is composed of measures of credit conditions, and again, that's for household and non-financial household. And the leverage subindex consists of debt and equity measures, and we will look at all the indexes that make this up. Increasing risk, tighter credit conditions, and declining leverage are consistent with increases in the index. So here I put loose, lower risk, higher credit availability, and higher levels of leverage. That's exactly what the market was doing down here, introducing higher levels of leverage, and in doing so, we noticed that the credit spreads, the OAS, on both IG, investment grade, and high yield bonds contracted, which also had an effect of loosening credit conditions or making credit more available by making the spread smaller. We don't have to read the rest of this. Let's have a closer look at the site that we got this from, and then we'll come back and interpret some things. Okay, this is the Federal Reserve Bank of Chicago. All the links are in the description box below. The National Financial Conditions Index. And it gives you two. It gives you the NFCI, and then it gives you the adjusted NFCI. And this goes all the way back to what's our date back here? All the way back to the early 70s. You can just drag this and you can zoom in on the current period this way, and you can see exactly what the measure of each component is. Notice that the black line, the index itself, is the sum of the three bars because there's no adjustment. Here's your adjusted index, so we'll drag this forward to zoom in on the current period, and there's where you see that the black line is being pulled by the amount of the adjustment all the way through to there. If you want more information on it, more background information, you can click on background, and you can get this extra narration here. If you click on download list of indicators, you will get the list of indicators. So the risk indicators are all here. Scroll down, you will get all of the credit indicators that they use, and if you scroll down more, you will get all of the leverage indicators. And you can see that a lot of these leverage indicators are a result of actions taken in the market by financial market participants. So the first one here is the S&P 500 financials divided by the S&P 500 price index relative to the 2-year moving average. And you have codes over here. LV means levels, MA is moving average, D is difference, first difference, LN is the log of the first difference, Q is quarterly. So these are time series for the most part. So why would we use for something like this, if you remember your level 2 time series analysis, why would you first difference something? You would first difference it if it wasn't covariant stationary. If that didn't work, you would take the first difference of the log and you'd see if it's covariant stationary. So that should help you understand, well, why are you taking the first difference of something? Because it was a time series that wasn't covariant stationary, right? And then why are you taking the log? Well, maybe taking the first difference wasn't enough, or maybe one of the variables needed a different scaling. Maybe we're interested not in the levels of a variable, but in the growth rate of a variable. So by taking the log, we isolate the growth rate of that variable, right? All of these codes are down here, so you can get all the codes down here. These are a lot of indicators. I think there's 105 indicators in all. So how do you keep all of this straight? It's rather complex, but if you go to Google Scholar and you type in financial conditions index, there are some good papers on how to construct a financial conditions index. And you'll have a bunch of indicators. But this is not a regression with the indicators. You're not using the indicators as independent variables. The first thing you have to do is you have to reduce the amount of variables you have. 105 is simply too many. There must be some principal factors behind all of these. So we're going to use, can you figure it out? If I said principal factors, we must use something called principal components analysis. So if you recall level 2, the reading on big data, when we have a whole bunch of variables and we need to reduce the complexity of our data set, we'll use PCA, principal components analysis. And what it does is it will extract from the data a vector, and a vector is just a weighting of all of these variables, some kind of weighting. You look at the term up there, weight, right? A weighting of all of the variables that you have to form a vector, and that vector becomes a factor. There is one factor that is common to all of these, and it weights, it has this much effect on each one of these variables. There's factor 1. And then it will grab the next factor that is orthogonal to the first one. Orthogonal means completely uncorrelated. And it keeps grabbing these uncorrelated factors until, and each factor is associated with an eigenvalue. I think I'm helping you remember something now, right? And you will continue to extract factors until your eigenvalue is below some above some threshold like 0.8 or 0.85. I believe that this one is done with the first five factors. So you're reducing the complexity of the regression down to 5 factors. Typically, you'd have the problem of naming the factors after, but they don't really need to name the factors here, so they don't. So there's your risk indicators. This is risk indicators. Next is your financial indicators, and then you finally have your leverage indicators, not financial indicators, credit indicators. This may be interesting on its own for you to look at, to look at what some of these components are. There may be one of these where you say, well, that's interesting, let me look at that. Or this is interesting, the way that they measure this, or they're measuring that, or looking at this kind of thing. It may highlight to you, maybe in some of the models that you have, some interesting measures that you may want to add as well. Okay, let's get some kind of conclusion here. See what was going on over here? This is the zero line right here. See this over here? That's where they want to get to. What they call sufficiently restrictive stance. That is a restrictive stance. This is accommodative. This is average, conditioned on what we see in the economy. This is an average level. This is restrictive. They want to get the index line up into this territory. It's down here. Well, if the market decides, you know what, the Fed's going to pivot, they're going to have no choice, and they're going to do their little sing-song again, Fed's going to pivot, Fed's going to pivot, what's going to happen with the leverage bar? It's going to get bigger and bigger, and it's going to pull the index down, which means to get the index higher, they're going to have to raise rates to work on risk and credit even more than they would in the absence of the market fighting them. So the worst thing that could happen right now, not the worst thing, but among the bad things that could happen going forward, is the market gets it in its head that no, we're back on the song. The Fed is going to pivot, and they start running the market up, buying bonds, long yields start dropping again. Well, that makes debt cheaper, right? Credit spreads start to contract again. Well, again, that makes debt cheaper. And that'll do something like this for the index. It'll pull it down. So the interest rate will have to go even higher to work on the blue and the red components to get it back up into here. And the worse the economy gets, the bigger the adjustment will then become. So if we want, here's the ironic thing, if we want to cause a recession, let's have a rally. Let's push asset prices back up. Let's push bond prices up and yields down. Here's the ironic thing. In the end, it would be financial market participants that are causing the recession and not higher rates. You want to avoid a recession? Relax. Take your hand off the keyboard and relax and do nothing. Let's just go sideways here for a while. If we can go sideways, the Fed can do its job. It won't have to lift the interest rate as much as it would otherwise have to lift it if the market wants to fight against the Fed. So the big risk right now is not a policy mistake. I think the big risk right now is a financial market participant mistake, or a Wall Street mistake, if you want to just sum it up in one big term, is expecting something that the Fed says you should not expect, is pricing in something the Fed says don't waste your time pricing it in. And they have to say that, because if they said anything otherwise, well, then financial conditions would loosen and it would not get them to where they want to be. They want to get to a destination. Let them get to a destination. But if we're at 3,900, and if for any reason the CPI is out on the 13th, and if that comes in benign, and you start getting another 100, 200 point rally into the end of the week before the Fed meeting, I guarantee you they'll go 75 basis points. Maybe even 100, but they'll go 75 because they'll have to. They need to get the market to say 39 is the ceiling, let's hang out here. And I don't think that they care too much that you bounce between 38 and 39, maybe even 38 and 39.50 or 4,000. But if you start running back up to the 200-day moving average to test it again, saying, oh no, the bottom's in, that means we're going off to new highs by the end of the year. If you believe that, no, we should be at 4,800 by the end of the year. If you think 4,800 by the end of the year is realistic, you have to believe that 5% on the Fed funds rate is going to happen. They will move together at this point, because this green bar right here is all of you. So you do have a job to do, in the sense of stay off the keyboard. Just relax for a while. The more the market gives way, the sooner we all get out of this, the more likely we'll get a 50 basis point increase in September. Which, and here's my thinking, if the market pulls back, and the Fed says, well, thank you very much for for raising the index here. We don't have that much to go to get it into restrictive territory. We'll go 50. If they go 50, they'll probably cause a rally, thereby undoing the very 50 basis points they did. So I don't see how they can't go 75 basis points no matter what. I just can't see how they can't go 75 basis points at this point. So even though the market is placing, I think, what was the probability? Let me just scroll back here while I'm sitting here. They're placing a 57% probability of 75 basis points. Call it 60, a 60-40 on 75 to 50. I'd be higher than that 60% only just by using a little bit of game theory. If I go 50, I'm going to cause a rally and undo the very 50 that I did, because everyone's going to start saying, aha, Fed's going to pivot. I must go 75 to kill the Fed is going to pivot story, but 75 may be just too much. However, if we're going to get to 3.75 or 4 by the end of the year, why not just front end load it? As long as I can back them off for a while, maybe I can forego a rate increase in December once the market figures it out. I think 75 is probably in the works. And if the market can go sideways, yeah, I think 75. If the market rallies, you can guarantee 75, maybe even 100. So when that CPI report comes out, it will probably be benign. It'll probably show that no, things are improving. Just take your hands off the keyboard, because if you put your hands on the keyboard and start trading, you will force the Fed to go even higher, and you will be the ones causing the recession, not the Fed. Kind of ironic, isn't it? Okay, let's look at a number of measures. Just sort of get a handle on a CPI when we get it on the 13th for the month of August. If we think it's going to be higher or lower than expected, and I think it'll be lower than expected. I think that it will come in sort of like August. The core, the month-over-month core, will probably show the sticky component, but I think headline will have receded quite a bit. And hopefully the market will take it in stride and just sit tight and not decide to rally, because if they do, they are cementing in a 75 basis point hike. Look at this is the Global Container Freight Index. We've visited this a few times this year. 52.86. Look at the drop off that continues to happen. As far as transporting something that's more dry, these are freight containers, right? And if we look at dry bulk, like iron ore, 1086, look at where it was up here, almost at 3500. This was several months ago. We're down to 1086, and if you look at this price, going back, there were periods of time, 2018, 2019, where it is above that, and just a few periods where it's below. So it's pretty much at a long run average rate, and this continues to drop. For the New York Fed, we've visited this one before as well, puts out the Global Supply Chain Pressure Index. Look at it coming right down, and we are hearing this from more and more companies that supply pressures appear to be easing or have eased over the last few months. And if they're easing, so are price pressures. That is coming down. On to energy. We'll look at both U.S. and European benchmarks. For oil, the U.S. benchmark is WTI. The ticker is CL. Down 24%. Here's the closing on Friday. You can see this big down move during the week. Down 24% from the high close, which was over here, which was on June 7th. North Sea Brent, this is the benchmark for European oil. You can access it with the code BZ. Down 19.8% from the highest close on June 7th, and it also had a big down week as well going into the end of the week. Natural gas, not so much. We close over here. Up here, so if we draw our line across here, we're still quite elevated, but the high close was August 21st. The closing price on Friday was down 9.2% from the high close. And in Europe, the Dutch TTF gas futures as of 3:59 on Friday had closed down 38% from the high close, which was August 26th. November futures are sitting at 220.63 on their closing price. I don't know if this holds. We haven't hit the winter season yet in North America. So, where do we go from here? And we know that Russia is going to most likely use gas as a tactical weapon, not against Ukraine, but against the rest of Europe, to stay out of their way. And they do have the power to shut it off completely. And if they do that, you're cementing an absolute recession in Europe, being that 40% of the earnings of the S&P 500 come from outside the US, I don't know that you can continue to hold your EPS estimates where they are without downgrading them 10 to 15% if that happens. So there is huge earnings risk going into the winter. And with natural gas futures in the US already elevated, you haven't even hit the winter season yet. You get a polar vortex happening somewhere, and it happens somewhere. You know, when it's happening in Europe, it's not happening here. And if it's happening here, it's not happening in Europe. Where's it going to happen? Probably the worst place to happen is Europe, because, well, you need gas at that point. You need it. So that's going to drive up prices everywhere. I don't know so much that what we see in here, this congestion period, can cause any month-over-month changes in CPI, only because it's a small component into CPI at this point because we're not in the winter months. But this is certainly going to help up here. In fact, if you have a more technical eyeball, you might say, hang on, you've got a double head and shoulders pattern forming here that you might actually have a downside price target somewhere in the high 60s. If your eyes look at that, and over here you might say, looks like that's an upward pennant flag formation, which might lead to a breakout if you, again, think in those terms. So I want to talk about share repurchases, because we are coming up on the end of the year. January 1st, that new tax on share repurchases kicks in. It's 1% of the value of the share repurchase. And I have heard a number of analysts arguing for higher prices into the end of the year and an end-of-year rally with all the companies that are going to rush to complete their share repurchases before the end of the year. It's not that simple, and it's not that straightforward. So I thought it would be worth going over some of the rules of share repurchases to see what's involved in this, and to determine whether or not this is something that can happen. There is a record number of repurchases that have been mentioned this year. Over 400 billion, approaching 500 billion, half a trillion of repurchases. But given the rules, it's hard to see how they're going to get that done by the end of the year. So let's just see what we have in terms of repurchases. We should be aware of what rules companies have to play by. And I've got the link for this, all of this, down in the description box. It's from a Skadden Arps, which is a pretty well-known law firm, and this is right off their website. So we'll just read through some things here. Beginning December 1st, 2021, the SEC proposed a slate of new rules and disclosure requirements. And in fact, they're working on another disclosure requirement that would require any firm that buys back its shares to disclose it that very day. Whatever they buy back that day, to disclose it, as opposed to just doing it quarterly in the 10Q. To actually disclose it that day, they got a discussion paper out about that now. New rules and disclosure requirements intended to address what it perceives as potentially abusive practices engaged in by public companies, directors, and officers related to Rule 10b-5-1 trading plans. And we'll talk about that here. Among other things, the amendments are intended to reduce the potential for opportunistic and harmful use of repurchases by company insiders who may seek to exploit informational asymmetries between themselves and investors. Current proposals include imposing a mandatory cooling off period of 120 days for officers and directors, and 30 days generally between when a plan is adopted or modified and when trading can commence. So if you are buying back your shares under Rule 10b-5-1, which is a trading plan. Trading plan means you have no discretion over it. Once you set the plan, you give it to the broker executes the plan. That's it. And it's really meant to protect the company from accusations of trading on inside information, that they're buying back shares in the market because they know the company's about to explode. And they're buying shares, the insiders are buying shares, and the company is buying back at the same time. If you give it to a broker and you say you execute it whenever you want to execute it, then it sort of eliminates any accusations going back to the company on that. This cooling off period of 120 days is saying once you announce the buyback and you set the plan, no insiders can buy for 120 days. Well, you don't know what's going on with the plan. And the company cannot start for another 30 days until the market digests this information. So if a company says on August 20th, we're going to buy back shares under a trading plan, they actually can't start until September 19th, 30 days later, right? So here's the 10b5-1, which this is, kind of makes it a little odd. It can be terminated at any time. It's like it's out of our control until we want it in our control, period. A company engaged in a share repurchase program can, they don't have to, they can establish a trading plan pursuant to Rule 10b5-1 in order to provide instructions to a broker to effect repurchases at a later date. The plan can be used to establish an affirmative defense to a claim that a company was aware of material non-public information when any such repurchases are then effected because, well, they're not in control of the repurchases. So right away, hey, don't blame me. I wasn't in charge. We had a trading plan. In good faith, we wanted to buy back shares. A broker executed it without our involvement. We don't know when they bought, what they bought, how they bought. So obviously, we weren't acting on anything, right? So the positive, it can continue buybacks if they're in possession of material non-public information. So once they set up the plan, 30 days later, the broker can start executing. And if directors or executives of the company come into possession of material non-public information like a pending merger or something, the buyback can still continue. Whereas if it's not under a plan, it would be questionable if the buyback would continue because legal counsel would say, well, now hold on. What if somebody sells their shares to you because of the buyback and you were sitting on this information knowing that the price was going to go up $40 in 2 weeks? That's a lawsuit, right? So you'd almost have to disengage from your share buyback plan if you had that. Whereas if you have the plan, you sort of have a safe harbor to continue the buyback even though you become in possession of that information. The negative is you lose discretion over purchases, which means you may, looking at market conditions, you may say, don't buy back at these levels. Use it to buy back to support the stock if the price of the stock drops, but don't buy it back now. Well, you lose that ability. Okay, here is the section on open market share repurchase programs. You're not going to use a trading plan. You're going to buy it yourself. What legal issues should a company be aware of as it designs and implements its repurchase program? The two big ones here are timing and volume. Most companies involved in share buybacks typically will avoid the first half hour of the day and the last half hour of the day. They don't have to. There are certain times of the day that they have to avoid. But to be clear of any suspicion, they tend to avoid the first half hour and the last half hour. So if you want to know if a company has been supporting its stock throughout the day, you see the market down, but the company that you have has a share repurchase program and the stock has been well bid. It's not dropping. Wait till 3:30. See what happens after 3:30 because typically they pull their purchases at 3:30. Even though they don't have to, they can wait all the way to 10 to 4, typically all the way to 10 to 4, just to avoid any suspicion and to be perfectly defensible in court. They could say, look, we didn't trade anywhere near the limits. For a security, during the preceding 4 weeks, and when we're talking about the average daily trading volume, it is for the 4 weeks before the day in which you're buying it back. So every day that has to be calculated. For a security during the preceding 4 weeks, has an average daily trading volume of at least $1 million and a public float of at least $150 million, which is pretty much any significant company out there. It says here, the purchases must not be made during the 10 minutes before the scheduled close of the primary trading session in the securities principal market, or during the 10 minutes before the scheduled close of the primary trading session in the market where the purchase is made. So you have to stop buying back your shares 10 minutes before the market closes. If you don't meet this, it is 30 minutes before the scheduled close. The reason is you cannot create a chart pattern. So there is information in the closing price that technical analysts look at. So you cannot use your repurchase program to create a chart pattern. There has to be market-driven supply and demand at the end of the day and at the beginning of the day. There is another condition. I'm not sure where it was written, but there is another condition that says that you cannot be part of the opening auction. That means you cannot set an opening price. I think it's down here under price. Let's see. Purchases must not be made at a price that exceeds the highest independent bid or the last independent transaction quoted or report. This just means that you can't go outside of the bid ask. Let's see. Companies. Okay. No, I forget where I read it, but usually they cannot participate in the opening volume, which means they can't set the opening price of the day or the closing price of the day. So usually they don't start buying back till 10 in the morning. The first half hour they'll avoid in the last half hour, even though they can go all the way to 10 to 4. Just to be safe, you get it done there. So there's timing. Look at volume. The aggregate purchases on any given day must not exceed 25% of the purchased securities' average daily trading volume. Block trades will typically will be included in computing a security's average daily trading volume. However, once per week, in lieu of purchasing under the 25% limit for that day, a company or its affiliated purchasers may make one block trade of its shares without regard to the volume limit. So if there is a big seller that wants to sell like 3 million shares all at one time, and if they say for the day, look, we'll forego this 25% limit, we won't bother trying to hit that limit in the open market transaction. Instead, we'll do this big block. They can do that block without regard to the limit of shares that they buy in the block. They can do that once per week. So let's look at GM. Let's look at the disclosures GM made, and let's see if we can figure out how much GM can buy back before the end of the year. All right, I have two things here. This is the first screenshot I took. This is the second. Let's look at the first one. This is from their last quarterly report. Item 2, unregistered sale of equity securities, use of proceeds. This is the purchase of equity securities. We can see the amount they have left in their repurchase program. They tell us here January 17, the board of directors had authorized a purchase of up to $5 billion of our common stock with no expiration date. And every quarter they have to tell you for the quarter on a monthly basis how many shares were bought and at what average price. So we see April, for the month of April, 36,000 at 42.96 per share. May, nothing. June, nothing. While their stock was just tanking, they did not step in to support the price at all. That's just disappointing. They didn't step in to support the price, even though they had $3.3 billion in which they could have used. They did not use it. I remember before the second earnings announcement, I kept saying, they need to announce the reinstatement of the dividend. They got to do something to support their price, and they didn't do that, and they didn't use their share repurchase, and that's when I started thinking, you know what, Mary Barra's got to go. These are three big mistakes that this person has made. Not spinning off Cruise on an IPO when the market was hot for that kind of thing. Not doing that, number one. Number two, not protecting your stock on the way down, even though you had $3.3 billion of which you were authorized to use. And number three, not reinstating a dividend to give a floor price to your stock. It's nice to see that they did reinstate the dividend after I got out. Isn't that always the case? I had sold deep in the money calls to make sure that I was out on expiration date in August. And on expiration day, that Friday morning, they announce, hey, what about a dividend? That Meldrum guy was right all along. It's like, you son of a bitch. You knew I was doing this. Anyways, I'm done venting about that. Here is what they said on the morning of August 19th. The company announced that it intends to opportunistically resume share repurchases. That indicates no trading plan. So the 10b5-1 does not apply. Opportunistically resume share purchase under its share repurchase program. So they're going to resume, because it looks like they just didn't. They just left it. On August 16th, the board increased the capacity under the company's existing share repurchase program to $5 billion. So it was 3.3. They topped it back up to $5 billion. They got a market cap of $56 billion as of the close of Friday. They want to buy back $5 billion out of 56, so they're buying back 8.9% of the company's equity. At $39 a share on average, they can buy 128.2 million. 25% of average daily trading volume is about 3.6. So if they did the 3.6 every single day, it would take 35 days to fill. 5 trading days a week would take 7 weeks. So they could get this done by the end of the year. This $5 billion, if they do nothing and they roll it over into 2023, that's a $50 million tax hit after January. So there is a motivation to buy back as many shares as you can into the end of the year. However, I don't see why this necessarily need cause a rally, because you're going to opportunistically buy them back. The best return to shareholders is not push your price up and buy on the way up, but to find a price that supports your stock, probably around book value, because if you are trading under book value, you want to get it to at least there. GM's book value is 39 to 40, which is where it's been hanging out. And if you look at their share price since their announcement, it's holding up very well at around 38.50, 38.60. Even though the market is weak, that thing holds up pretty well. I do see weakness after 3:30. That after 3:30, if you look at the price action on the chart, when it does finish down for the day, it usually drops after 3:30. So, it looks like the footprints of a buyback going on, and it would make sense if you have that tax coming in, that 1% tax. If you had this buyback, why not top off the buyback, try to get in as much as you can, reinstate the dividend, because you're probably going to say, never mind the buybacks anymore. And that 1% tax, I don't know anyone that believes it's going to stay at 1%. What is the dividend tax? Look at what taxes are on dividends. It is a form of dividend. That 1%, that's just the beginning. So being that there are, I think, like over $400 billion of buybacks that were announced as of Q2 this year, if they do try to squeeze it all in, I don't know that will cause a rally, but I do know that can be supportive of the market. So to say, is the low for the year in? Maybe. Is the low for the market in? I don't know. But for the year, maybe. Okay, this is week in earnings, September 2nd, 2022. I don't think anything is exciting at the top part. We've seen pretty much everything there is to see at this point. Let's go down to the estimate of forward earnings, which is on page 10 here. There we are. 232.57. I got a big question mark on that one. I'm not sure that that's the right number. I think that's a little aggressive at 232.57. I think it does have to come down, but let's see what kind of fundamental levels that gives us. Okay, this is a 2-year chart for SPY. We just saw that our forward EPS is 232.57. And to be clear, that is for Q3 of 2022 all the way out to Q2 of 2023. It is the next 4 quarters, the forward EPS. Once we get into earnings season in October, this falls off and the next one comes on. So when we talk about the forward earnings, we'd be talking about Q4 22 to Q3 2023. Once this one falls off, we will then start to get earnings and some guidance as to what we can expect for the quarters going forward and the full year. I don't know that we'll get much past Q4 or Q1 23 as far as guidance goes. But I think this might be a little rich at this point. September 2nd closing was 39.24.26. That puts us at 16.87 times these forward earnings. So, we can look at that and say, well, that's a fairly good price for the index. And you might think that that's a good enough multiple. But if your E is wrong, well, then your price is wrong, even though you might agree on the multiple. You might say 7 times, 17 times, which is below 17. 17 times, yeah, that's good. That's in line with the last 5-year or 10-year forward average, good enough. But again, it's your E. You know, I don't know that many people are going to question a 17 multiple, but it's the E. 18 times is 41.86, 16 times is 37.21, so it puts a band around where we are, a one multiple band around where we are now. Downward pressure, what I think is keeping the index from going up. Well, you got a Fed. Higher for longer is the words that they're using, right? You got a European winter coming. What's going to happen with gas? That's going to be a big deal. China growth. We know that property sector is in trouble, and property made up about 28% of GDP, whereas in most other countries, in the US, I think it makes up 16 to 18%. And you have had significant overbuilding. Is it going to make up 28% of GDP on a going forward basis? Probably not. So if that falls, down to 18% or maybe even 12% because of the overbuilding, there goes China's growth. And if China is the growth engine or the factory of the world, that's, even if it can still be the factory of the world, it's still going to have 0 to negative growth because of that. So that's got to be a weight on any upward price movement. What is supporting the market? Share buybacks, I think, can be supportive. I think when you say I'm going to opportunistically buy back shares, which is typically the wording that would be used, implies that we will support our price in the market when it's weak, as opposed to just driving up our share price to show momentum. Will at least support our price in the market if it's weak. Aggregate incomes, as we've seen, are increasing. Even on a month-over-month annualized basis, aggregate incomes, that's the amount of money available to be spent in the economy, is increasing by 4% on a going forward basis if you take the last month and annualize it. And in the US, marginal propensity to consume is quite high. Consumer confidence is increasing because if you can get gas prices to go down, you get consumer confidence to go up, and supply pressures are easing. That is supportive, I think, of the market. So we do have some pressure. And once you start pushing up along here, you got to say, hey, this is still here. And once you start dropping down here, you got to say, hey, this is still here. So I think you have a range, right? So as the market dropped into Friday, I was reducing. Remember, I had said that I had negative DDB last week. That's a dollar delta beta. I had negative, well, I was moving it towards 0, not by adding long positions, but by covering short calls. I have very few new long positions that I added, and the only new long positions I added were all apartment REITs, because rents are not going down. There's no place to go. We have a housing shortage. Rents are not going down. The idea that REIT prices are going down and cap rates are going up only makes me happy. I'll take it. Thank you. So I covered my short shares when the market got below 392. I had short SPYs. I covered my short shares and I traded them for 390 short calls. That allowed me to pick up about $6 a share, meaning that I'm selling the 390 call and at 392 on SPY, and I'm getting $8, which means if SPY goes from 392 to 398, it is the same thing for me as covering at 392. So I basically have $6 of upside protection on that by trading my short shares for short calls. So I got a pickup of $6 a share, and if it continues to drop, well, these are September expirations. They're going to expire fast because there's only 9 trading days left. At this point, I don't know what to do. I'm going to let market action dictate what I'm going to do. If we start getting a rally back up, I know that the Fed is only going to have to raise rates higher than they would. I will short. I have no problem doing that. If we drop, well, that is sending the Fed in the right direction. The Fed may say we probably don't need to go as high as we thought we did. or for as long as we thought we would. If the market can do this for a little bit longer for us, then I would be a buyer. As we move down to these lower rates, I would then move from zero upwards to having positive DDB. The closer we got to a 16 multiple given the current forward EPS, and the higher we got to an 18, I would be adding to the negative side. So it looks like around this level I'm neutral on the market because I think this is the right place to be. I think this is a place where the Fed doesn't need to prove their resolve. I think they just need to act with prudence. And this is a place, I think, where the market probably gives itself or guarantees itself the least amount of pain. Look, the market's not getting away without pain. How much pain is up to them at this point. If they want to rally, there'll be more pain. If they want to hang out here for a while, they don't need to sell off. They don't need to rally. They can trade in around 3,800 to 3,950, and the Fed won't even notice them. They'll swim right under the shark. And, that's the safest place to swim. You ever see a shark swimming in the water? You got all those little tiny fish swimming underneath the shark? It's because the shark can't see what's underneath them. So that's the safest place to be. If you're ever in the water and there's a great white shark, try to figure out how to get underneath them and just hang out there, like right underneath them. And just hang out there and he can't see you, right? And no one's going to attack a great white because they got to come up to the great white to attack it. The safest place. I think the market should swim right under the belly of the shark right now until the Fed is doing what it needs to do. Anyways, there it is. There's really not much to talk about other than that, and maybe get a little bit more perspective on the financial conditions index. And what role the market has to play in getting through this as best as possible. Let's look at the week ahead, and we'll wrap it up with our quiz. Okay, the week ahead in the economic calendar for the U.S. There's really only one economic data point. There are two big Fed speakers. For Canada, there is a big event. So Monday, the markets are closed, Labor Day. We come back on Tuesday. ISM, non-manufacturing PMI, last was 56.7, expecting 55.5. ISM says the cutoff between contraction and expansion is 48, not 50. So quite a ways to go. So when we look at employment at 49.1, being that they give 48 as the cutoff, that's still in expansion territory. What we'd like to see is the non-manufacturing prices index drop from 72 down. So I think that'll be the more important sub-index to look at. Wednesday, mortgage applications. I don't know that this is interesting anymore. I don't think that anyone thinks this is going to change its trajectory. Then you got balance of trade for both Canada and the U.S. And here's the thing that I find odd. We are expecting in Canada a trade surplus. Whenever you have a trade surplus, this is the country getting richer. If I go to the store and I spend $10, I'm just circulating that same $10 within the economy. The amount of wealth in the economy has not increased, but a trade surplus increases the amount of wealth in an economy. Yet, the currency gets no respect, none whatsoever. When we look at the U.S., you look at their balance of trade, it is coming in from 79.6 previously. The forecast here, 70.5. It's expected to contract by 10 billion, which is 10 billion less of wealth that has left the U.S. If it comes in lower than that, I guarantee you the dollar will get respect. For some reason, Canada can come in at another 5 billion. Beat the expectations, and the currency will get no respect. I find that odd. Anyways, there it is. King dollar. We got to say something about the U.S. dollar being so strong. That can't continue forever. At some point, it's going to turn around. It's just hard to see it turning around unless the euro becomes an alternative. And right now, it's not. So when the euro becomes an alternative, I think the U.S. dollar will start to, peak out and start to turn down. I don't know when that happens. So, there it is right there. We're not so much looking at the U.S. dollar anymore, but if you're wondering, when other currencies are going to turn around, I think it all comes down to, well, when is the euro going to stop weakening? Is the same question as asking when is the U.S. going to stop strengthening? Here's Canada's big day, Wednesday, 10 o'clock. The Bank of Canada interest rate decision, 75 basis points is expected, going from 2.5 to 3.25. If we get 75, I don't know that the Canadian dollar gets any respect. The last time we were expecting 75, it went 100. The Canadian dollar, I think, got a day and a half of respect, and then nope, we don't want this, and down it went. So I just don't know. What do we got for the Fed? Brainerd, following the next day by Powell at 9:10, being that what has been said has been said. I don't know what more needs to be said. I don't expect any change in the message at all. The one thing that I would like to see is some indication that these press conferences will be canceled. Greenspan never used them because he understood, why give the market anything? It's only going to mess me up. Why give them anything? Bernanke brought them in, and Yellen kept them on a quarterly basis just because they were such extraordinary times. Let's keep the market aware of what we're doing, because they knew that they could use market expectations to help loosen financial conditions. Well, now that's going to work against the Fed. Any kind of expectation of anything good is going to work against the Fed. So basically, the press conference is going to have to be doom and gloom the whole time. And we know Powell, if he goes off script with questions, he's not eloquent. He's going to risk telling the truth. And if he tells the truth, well, then it's all over again. And, the market may undo the very thing that he did. So I think they did a smart thing by canceling forward guidance. The next thing is get rid of the press conference. Just get rid of the press conference. You don't need it. You've already made your statement when you made the interest rate decision. You released your statement. You've already said it. There's enough Fed speakers all week long that can get the message out. You only risk making things worse with the press conference. You only risk that. Get rid of the press conference. So maybe this week they'll talk about perhaps suspending the press conference, or maybe even going back to quarterly press conferences, or even semi-annually. But I think that would probably be a good idea, unless you have somebody who can think a lot faster on their feet than Powell can. And that's about it for the week. Canada has its jobs report on Friday. Last time was negative. Forecast is for 15 positive. If we get anything positive, I expect the dollar to get some respect for about 38 seconds before the market says, nope, we were right the first time. No matter how good things get, we don't want this thing. Again, I'm puzzled. And then that's about it. 12 o'clock on Friday, you have Waller, but I don't think it's going to matter much. You have the vice chair followed by the chair. And there's really not a lot going on this week in U.S. economic reports. Earnings are still, a month away, and CPI is until the top of next week. Not next week, but the week after. So there's nothing to talk about next week. Nothing to talk about. It's a whole week of what do we do? Well, it'll be the narrative. Whatever narrative rules the week, that's the direction that we'll trade into. Whether it's going to be, CPI is gone and, up we go, or no, the Fed is pretty serious here. And if we go up, they're just going to raise rates even higher. So let's just hang out here. It's going to be an interesting, boring week, if you can put those two words together. An interesting, boring week next week. At least that's what I expect. I expect we'll go up a bit, we'll go down a bit, we'll go up a bit, we'll go down a bit. I don't see a catalyst for anything. However, if there is some exogenous event, well then, all bets are off the table. I think the big market mover probably would be anything going on with the gas situation in Europe. Whether it looks like it's going to get worse or whether it looks like it's going to get better could be a mover. So keep your eye on, across the pond. But as far as in our own backyard, And other than Canada, with the Bank of Canada rate coming up, other than our own backyard, I think, nothing to see here, folks. And that'll wrap it up for the week.